Introduction from Fresh Berhad. The company is public limited liability company that was founded and is domiciled in Malaysia. The company's main business activities are farming, manufacturing and distribution of various dairy product and plant-based product. Note 5 to the financial statement contains information about the subsidiary principal activities and specific. The nature of these activities for the group and the company did not significantly change throughout the fiscal year. MFRS 1 seat PPE for the Farm Fresh recognition. All items of property, plant and equipment excluding right of use asset are initially measured at cost. Cost includes expenditure that is directly attributable to the acquisition of asset. For the measurement, subsequent costs are included in the asset's carrying amount or recognized as a separate asset as appropriate. Only when the cost is incurred and is separable to the future economic benefit associated with the subsequent cost will fall to the group and the cost of the asset could be measured reliably. The last one is presentation and disclosure. Depreciation is based on the cost of an asset less its residual value. Significant component of individual asset are assessed. Depreciation is recognized in the profit or loss on a straight line basis over the estimated useful life of each component of an item. MFRS 1.0 for the Farm Fresh Berhad recognition. The group records a right of use asset and a lease obligation at the start of the lease. For the measurement, for low value asset and short-term leases of 12 months or less, the group opted not to record right of the use asset and lease obligation. The lease payment from these leases are constantly recorded by the group as an expense for the term of the lease agreement. Meanwhile, when the company acts as a lessor, the group determines if each lease is an operating or financial lease at the start of the lease agreement. For the last one is presentation and disclosure. The right of use asset is depreciated in a straight line manner from the start date until the earlier at the end of its useful life or the lease term when the company acts as a lessee. The expected lifespan of right of use asset are calculated using the same criteria as property, plant and equipment.
Fraser and Neef Limited (FNN), founded in 1883 by John Fraser and David Neef, began as a printing business and expanded into aerated water, dairy property development and publishing. In 2014, FNN demerged its property business, relisting it as Fraser Property Limited. Today, FNN is a leading Southeast Asian consumer group in the food and beverage and publishing and printing industries, leveraging its expertise in marketing, distribution, R&D and acquisitions. Listed on the Singapore Stock Exchange, FNN operates in 11 countries and employs over 7,200 people. Fraser and Neef Holdings Berhad recognized property, plant and equipment excluding right of use asset at cost including directly attributable acquisition costs. After initial recognition, assets are measured at cost minus accumulated depreciation and impairment losses, except for freehold land, which is only adjusted for impairment losses. Depreciation is applied on a straight line basis over the asset's useful life and charged to profit or loss, with freehold land not depreciated. Depreciation continues unless the asset is fully depreciated, even if the asset is idle. Fraser and Neef Holdings Berhad recognize investment properties as asset when they are expected to generate future revenue and their cost can be reliably determined, typically for rental income or capital appreciation. These properties are recorded separately from owner-occupied properties. FNN use a fair value model to measurement based on market evidence and comparable property price. They disclose the measurement basis, rental income, direct operating expenses, and provide detailed reconciliations and valuation methods in their financial statements to ensure transparency and compliance with MFRS 140.
Differences between MFRS 1.1c and MFRS 1.0 with MPRS. Measurement for MFRS, all fundamental financial instruments must be measured using the amortized cost model or at cost. For MPRS, PPE are valued using the fair value method. Scope and application of MFRS. MFRS applies to all entity in Malaysia and also aligned with IFRS. For MPRS, applies to private entities that are small and medium sized, and is also simplified version of IFRS. Depreciation, MFRS using the straight line method or declining balance method are both permitted under FRS. For MPRS require the use of the straight line method for depreciating PPE. For the disclosure, FRS has more specific requirement for related party disclosure and more extensive requirement for the disclosure of going concern, uncertainties and contingent liability. For MPRS, require less detailed disclosure of going concern, uncertainties, and less detailed disclosure of contingent liabilities and less detailed disclosure of related party transaction.
So the company for MFRS 116 is introducing Strawberry Down Berhad, where dessert is our main masterpiece and specialty. We love to introduce dessert that people have never seen or tasted, where it is our area of specializations, including delectable confections that not only satisfy people's craving but also make others feel inspired and aware of our desserts. It is probable that future economic benefits associated with the item will follow the entity. It is possible to measure the cost accurately. Item of plant, property and equipment, which is PPE of the company, are number 1, machinery, which used for manufacturing products. The second one, building. The business used the space for the office. And then the third one is vehicle, used for transporting and distributing goods. So number 3, estimate initial measurement for PPE by a different method for the given company is cost model. The cost of the PPE less any cumulative impairment losses and depreciation can determine its carrying amount. So the calculation based on machinery in number 2 of the company is initial cost PPE for machinery is 200,000 ringgit, useful life 10 years, and then annual depreciation, which is straight line method, is 200,000 divided with 10 years got 20,000 ringgit, and then depreciation value after 1 year is 200,000 ringgit minus with 20,000 ringgit and got 180,000. Revaluation model, which define is this method involves deducting any subsequent accumulated depreciation and impairment loss from the fair market value of the PPE on the date of revaluation to get carrying amount of PPE with dependable fair value. So the calculation based on machinery in number 2 is when the annual depreciation, which straight line method, is 210,000 divided with 10 years, which got 21,000, and then depreciation, it is depreciated value after 1 year, which is 210,000 minus with 21,000, and then we got 189,000. So unit of production method, which define is focus on output units than actual rate of time. The calculation based on the machinery in number 3 of the company is when the depreciation per unit, which is 200,000 divided with 2 million unit, and then got 0.10 units, and then actual output after 1 year we got 220,000 units, and then depreciation value after 1 year is 200,000 minus with the depreciation per units, and then we got the 178,000. Okay. So for the MFRS 140, introduced our company Hippolyte Berhad, a powerhouse and dynamic leader in the fast food sector in Malaysia. From our signature classics to innovative versions of food, we will always serve up deliciousness with a side convenience, which is we provide through drive-thru, and committed to quality ingredients and exceptional service. We are not an ordinary fast food chain. We also create our own recipe with culinary experience, where every bite is a burst of flavor and every meal is a moment of joy. So for the MFRS 140, it is probable that the future economic benefits that are associated with the investment property will fall to the entity. The cost can be measured reliably, which is Hippolyte Berhad investment property is number 1, 12-story building, and second is land. So the initial cost is the sum of the cost of building where it is first acquired or purchase price and any attributable expenditure such as professional fees and other costs. So the initial cost is when we add the cost of building and then the legal fees and then the other cost, and then we got an 85,082,000 ringgit. Subsequent cost, it is the cost that add to replace part of or service to a property such as repair and maintenance. This cost is recognized in SOPO, with the calculation shown is the subsequent cost, which we add the cost of replacement of roof with cost of updating the kitchen and the cost of repainting the building, and then we got 56,500.
Number 4, company Strawberry Dam Berhad using revaluation model for machinery cost in number 2 questions. So A, surplus or deficit. On 2016, we got surplus. On 2018, we got surplus. On 2020, we got surplus. And on 2022, we got deficit. And lastly, on 2023, which is surplus. B, revaluation model recorded as adjustment to the carry amount of PPA. C, cost model not applicable since use revaluation model. And D, depreciation, calculate amount based on revenue amount, which is 10 years. Next is company Strawberry Dam Berhad using the cost model for vehicle cost in number 1 questions. So A, surplus or deficits not applicable since use cost model, and B, revaluation model not applicable too, and C, cost model, which is historical cost is maintained, and lastly depreciation based on asset cost. This is calculation for revaluation model for machinery. As you see, we got fair value after add up with revaluation surplus and carry value. This is calculation cost model, which is for vehicle, and you can see the depreciation each year does not change, so we just times with 10 years. This is journal entry for machinery from 2014 until 2023. The depreciation amounts keep changing, which will impact the revaluation surplus or deficit amount. This is journal entry for vehicle. We got 200,000 from the amount we calculate just now. Lastly is accounting treatment. First, initial purchase, machinery recognized at cost 200,000. B, depreciation, calculate annually based on revalued amount and the remaining useful life of the machinery. And C, revaluation adjustment. In revaluation, any amount that increase or decrease is recorded as gain on revaluation or loss on revaluation in accounting treatment. And lastly is carrying value. For cost model, vehicle, A, initial purchase. Vehicle recognized at cost 200,000 and recorded as an asset because it will provide a future economic benefit. B, annual depreciation. Depreciation is recorded to allocate the cost of vehicle over its useful life. And lastly, straight line depreciation is used here.
For MFRS 140, Hippolyte Berhad had acquired building at cost around 75 million. The company used fair value model to do the valuation of the building. The valuation had been 5 times in 10 years. On 2019, we got surplus on fair value. On 2021, we got deficit of fair value. On 2023, we got surplus on fair value. On 2025, we got deficit on fair value. And on 2027, we got surplus on fair value. In B is the calculation for building using fair value model. This is the journal entry for building after we use fair value model to determine the fair value gain or loss for year 2027. In 2028, Hippolyte Berhad transferred the IP to PPE. We take the fair value at the end of 2027 as deemed cost for 1 January 2028. The useful life of the IP is 30 years. However, we already used it for 10 years and the balance is 20 years. So the depreciation we got 3,150,000 and we after minus it we got carrying value. This is the calculation for transformation of IP to the PPE. This is the journal entries for transformation of IP to PPE. And lastly, it's the accounting treatment for Hippolyte Berhad.